Well, the geopolitical risk that so many strategists and analysts flagged at the beginning of the year has arrived in spades. The attack on Iran by the combination of Israeli and US forces is ongoing. It's very clear that there's significant damage being done in the Middle East, and it's not just in Iran. And of course, it's that news that will likely dominate trading in markets this week. Now, for the record, last week we did see some pressure on US shares. The S&P 500 fell about 0.5% over the week. And that was in contrast to the experience in the Asia Pacific region and that ongoing rotation away from those highly glamorous and highly overvalued US tech stocks has continued to see good support for Asia Pacific shares. Last week, the ASX 200 was up 1.3%. Hang Seng was up almost 1%, and that sort of support is likely to be ongoing. These are international investor flows, and we're likely to see, in my view, to see ongoing outperformance by Asia Pacific share markets. Some evidence for that was in the individual stock action last week, and the volatility in individual stocks remains highly elevated. Now, that means that risks are higher and potential trading opportunities are also more abundant, but it is a highly risky environment in markets at the moment. Investors should be paying attention, especially where there are earnings results, because we've seen such big reactions in the market to individual stock results. Nvidia last week put out what many would call a stunningly good quarterly account, and yet its shares fell 6.7% over the course of the week. And it's an illustration of just how difficult trading conditions are in individual stocks and why so many investors are so glad that they're currently diversified across a number of stocks instead of concentrated in some of the ones that have been hit hard. Some experiences have been terrific. Dell, for example, on the periphery of the US tech, not considered one of the glamorous stocks initially, has been playing catch up as that rotation away from the most sought stocks continues. Dell was up 21% last week, an extraordinarily good performance. And we're seeing that in other sectors too. HSBC, despite already having made some strong gains over the course of the year, has gained another 10% in trading last week. And Block, the payments group, is up 27% for the week on the back of a strong result. But the focus today is likely to be on those markets particularly affected by the news out of the Middle East. Oil markets likely to be a key reactive market today. Now, we've seen the gap between Brent, the European contract, and West Texas, the American contract, open up to $5 in anticipation that there could be trouble in the Middle East. That seems to be almost certainly the case this morning. Brent closed last week just below $73 a barrel. Now, nobody knows with any certainty where it will open in trading this morning, but there are some analysts calling for $100 a barrel immediately. Gold, a similar situation. We're seeing good support there and strength in the US dollar as it appears many investors are battening down the hatches ahead of what could be a volatile week. Silver was up at last week as well, as was gold. And that positive momentum is likely to continue. So plenty to watch out for at the open this morning, as the Asia Pacific markets will be the first. The whole world will be watching how Australian traders react to the weekend news, given that this will be the first opportunity for a major developed market to trade after the invasion or after the attacks. However, we still have earnings to come in the US, and given the volatility we've seen in individual stocks, it's important to be watching, particularly where investors are exposed to groups like CrowdStrike, which will report this week, Broadcom, and locally we've got Capstone Copper also reporting. So still plenty of individual stock news to keep the markets moving. But it's really likely to be about the macro, especially this morning. The big question for markets is how long will this conflict run for? And there is no short answer to that. We can't say if the reports that 9 Iranian naval vessels have been sunk are correct. This might well be a very short-lived result. And although we might see a big spike in oil prices at the open this morning, if the conflict dies down very quickly and if there's regime change with peace in Iran, we could see things return to more normal footing by the end of the week. So it's very difficult to predict how this will go. There are all sorts of potential for miscalculation and for mishap. And of course, any increase in participants in the conflict in the Middle East would be a very bad sign. So we're watching the oil markets very closely. The reason for that is that although Iran is not a hugely significant producer of oil itself, given that its oil is sanctioned at the moment and it produces less than a million barrels a day, the reality is the threats that it's been making to shipping through the Suez Canal have been particularly concerning. A lot of ships have voluntarily stopped using the Suez Canal while this conflict unfolds. And that means that 30% of global trade in goods that is seaborne will be disrupted. Now, if the ability of the Iranians to disrupt the Suez Canal and the Straits of Hormuz is quickly contained, then we could see a return to more normal trading conditions. If, however, there are successful strikes on tankers, for example, there could be a very severe reaction and a longer disruption to markets. At this stage, we can't say which way the dice will fall there. However, it is clear energy stocks are likely to see good support today. Woodside, Santos, Beach Petroleum, all major producers, all likely to benefit from stronger oil and gas prices. Perhaps even more clearly, the big losers here are airlines. We're likely to see real pressure on Qantas and Virgin at the open today, as the disruption to global air flight will continue for some time out of abundance of safety considerations. So potentially big losers there in the airline sector. Other potential winners include gold miners, Northern Star and Evolution, the sort of Newmont, likely to see good support for gold prices and good support for gold miners in trading this morning. And of course, defence stocks with the huge use of armaments in just the last 48 hours likely to need restocking across the board. So groups like Lockheed Martin and Raytheon likely to find good support in trading tonight. It's also noted that the Iranians' attacks are not limited to military hardware and that they have potential cyber capabilities that no doubt US and Israeli forces will be considering. And so we could see support for groups like CrowdStrike, who provide defence against cyber attack. Rolls-Royce are also another potential beneficiary given their involvement in high-end engines. And locally, Drone Shield could be a beneficiary of the concerns being raised in the Middle East. We could see good support for Drone Shield shares in trading today. A number of traders this morning are pointing to the crypto markets as a sign of what might be ahead, because we initially saw real pressure on Bitcoin. It dropped down to around 63,000 US dollars. But since trading opened this morning, it has rallied back to about 65,000. Now, that's still towards the lower end of its recent trading ranges. But nonetheless, the idea that the first reaction was a risk off and the second was a moderation of that concern could be repeated in share markets. We might see initial selling, and then as investors realize that perhaps the concerns that they have are not being realized, we might see a bounce back. Turning to the individual stocks, and on the top of our watch list today is Virgin. And in a piece of unfortunate timing for Virgin, given the news over the weekend, it released its results on Friday after the market closed. And they were good. First half revenues were up to 3.32 billion. That's an increase of more than 9%. Earnings also went up, but only by 5%, suggesting there was some spending to get to those higher revenue numbers. But nonetheless, with earnings before EBIT being 493 million, it's likely a number of investors will be impressed with the result unveiled by Virgin. Virgin management pointed to its Velocity Frequent Flyer program as a driver of that increase in earnings, and their forward guidance was reaffirmed. The shares are down 10.5% year to date. A number of analysts have a buy rating, but I think, unfortunately, that strong result from Virgin is likely to be overwhelmed by the concerns for airlines globally, given what's happened in the Middle East over the weekend. Virgin possibly, if it gets caught in a downdraft, might move into territory where some investors will see good long-term value in Virgin. Life 360 is the second stock on our watch list today. It was up 3% last week and will report tomorrow morning, our time. So after the US close tomorrow morning, we'll hear from Life 360. Its shares are down 24% year to date, and it's been caught up in this software sell-off. And while nobody can say with certainty how artificial intelligence will affect software as a service groups like Life 360. It looks like investors are concerned and have sold this stock down. They sold it down so hard, a number of analysts have moved to buy ratings, particularly given that Life 360 continues to report record users, and a year-on-year revenue is expected to be up 30% at tomorrow morning's results. So one to watch out for ahead of that result tomorrow morning is Life 360. And the last stock on our list this morning is Netflix. It was up 22% last week after it lost out on its bid for Warner Brothers. And it was pretty clear investors were not convinced of the value in purchasing Warner Brothers by Netflix. It appears that the biggest tick here from an investment point of view is the fact that Netflix will not have to take on $50 billion in debt to do the transaction. Despite that huge rally back last week on the news that it was not going to be the buyer of Warner Brothers, the shares are only up 2% year to date. So it's really done quite a round trip on that whole transaction. It's actually down 2% on a 12-month view. So at the moment, trading below $100 a share, around that 96 mark. Most analysts have target prices around the 110 to 120 level. So they also, many of them tend to see upside, and a number of analysts have buy ratings on Netflix.